Good afternoon to everybody, and welcome to the 7th appointment of the Climate Finance Lectures, Workshop and Webinars organized by Fondazione Eni Enrico Mattei. I am Riccardo Spani, a researcher here at FEM, and I'm here with Professor Günther from University of Dresda, and Dr. Manuela Mazzoleni from Assogestioni. The series is part of the Firms and Cities transition towards a sustainability research program developed here in FEM. And the program is related and dedicated to the topics that relate to energy transition and transition towards a more circular and sustainable economic development path, with a particular focus on firms and cities, as I said. We adopt a scientific approach, making of quantitative and qualitative methodologies, and we support our research activities with dissemination activities made up of webinars and lectures and workshops, as this one here. And in this context, we try to observe and foster discussion on the regulatory initiatives and relevant research pieces, such as the one Professor Günther has published recently. Next year's appointment cover very different aspects, as I said. The next one will be a lecture by Professor Papadeas, from the University of Athens and Bologna, who will discuss how spatial econometrics will be useful with dealing with resource economics in particular. And on the 20th of November, we will have a workshop dedicated to the tools and methodologies dedicated to the assessment and identification of financial impact of climate-related risks and opportunities. This afternoon, Professor Günther will present the paper he wrote and the results he found in his paper regarding the relationship between firms' environmental performance and their financial performance. Dr. Mazzoleni will discuss with him the results, providing a point of view from practitioners. Before leaving the floor to our speakers, I would like to thank Professor Stefano Pareglio, who is the scientific coordinator of the FACTS research program, and FEM's staff for making this event possible. And of course, Net Community and the Italian Forum for Sustainable Investment, who collaborated to the realization of this webinar. And finally, also our partners CEPM, A2A, Acea, Cattolica Assicurazioni Generali, Unipol-SAI, and Utilitalia. So as I said, after Professor Günther's presentation, there will be a discussion with Dr. Mazzoleni, and at the end of which there will be a Q&A session. You attendees can write your questions in the question section you can find on the panel, on the dashboard, and I will manage to forward them to the speakers. The recording of the webinar and the materials will be published as soon as the event is over. So, Professor Günther, you may begin.
Okay, can you send me the link to upload my presentation?
Now you should be able to share your screen.
Just a second.
Yes. Okay.
Can you see it?
Yes. Yes.
Okay. So thank you very much for the invitation to present our work here. The topic of my presentation is on ESG performance and financial performance and the relationship. I will talk a little bit more on the E within ESG, so on the environmental issues, because this is where our paper is actually about. So I have 5 points to make. First one, an original question, a real good question, I would say, does it pay to be green? And the second is the answer to the first question, looking into some empirical evidence on the CEP. What do we mean with CEP? Corporate environmental performance and corporate financial performance relationship. So that is so how it is mostly addressed in the literature in research. My third point is going a little bit more into our paper. So it's about how do we measure things? How do we measure environmental performance? How do we measure financial performance? And what form of relationship are we assuming that both have with one another? So corporate environmental performance and corporate financial performance. Then I will present some results, especially on nonlinear relationships. That is, I would say, the most of the focus in our paper is on the nonlinearity of the relationship and what does it help for research and what does it help for practice. And that will also be my conclusion. So at the end, what do we learn from that for research? What do we learn from that for practice? So the starting point and also motivation of our paper is a question which is coming mostly from practice. Does it pay to be green? Should I invest in environmental issues? Is there any kind of payoff from corporate environmental performance? So that is, let's say, you could say, what we generally assume, what we perhaps hope, that there is a positive relationship between corporate environmental performance and corporate financial performance. In a wider sense, and that is a title, I would say, of our presentation here, does it pay to be sustainable? Yeah, because we have this ESG wording. ESG stands for environmental, social, and governance or governmental performance and corporate financial performance. So in my presentation, I will focus on the environmental issues, but there are also results and also papers and also so-called meta-analysis for the ESG, so you would say the broader aspect. So to put it a little bit in a nutshell, what are we doing here? What do we want to know in research? There's the theoretical level. The theoretical level compares two, I would say, constructs which we actually cannot measure, observe. So that is, on the one side, corporate environmental performance. Are firms doing good in concerning environmental issues or not? And what is the payoff in financial performance? And to analyze this, we have to go back on the second level, the empirical level. What is actually corporate environmental performance? That is not so easy, because I will also a little bit dig into that, is because it can be measured in different ways. I listed here 4 different ways. Can be carbon emissions, can be waste, can be hazardous waste, can be energy consumption, can also be other things like environmental disclosure or what you do in environmental management and things like that. That is all things and all, let's say, indicators that have been used in research also to operationalize this construct, corporate environmental performance, because you cannot observe that, you cannot measure that directly. So you need indicators for that. The same holds for corporate financial performance. That is also, I would say, a buzzword, which is very comprehensive. So what is actually corporate financial performance can also be measured differently. For example, total shareholder return, the benefit for the shareholder, market to book value is a very often used measure. If you have a listed firm which is on the stock exchange, you have a market value and you have the book value of the equity, and then you can compare both, the relationship of both, or return on asset or return on equity. And then we also have potentially other influencing variables, which we call control variables. For example, stakeholder pressure. We know that stakeholders use their power and have an influence and put pressure on the firms. Does it somehow distort the relationship? Does it depend on the industry? Does it make a difference if you have a manufacturing industry or a firm from manufacturing industry in relation to service industries? That is, for example, something what we examined in our paper. Does size matter? Larger firms have, for example, higher performance than smaller firms. For larger firms, it's easier to invest in corporate environmental issues than, for example, for smaller firms. So that are typically those issues which play important thing. Or the last issue is the environmental sensitivity of your industry relevant. Does it make a difference if you are in food industry or when you are, for example, in nuclear power plants or in cement industry, for example? Does this play an important, or does it make a difference? So that is a little bit, what is called the Libby box, the box which we want to open, what we want to analyze. Actually, we want to analyze what is the relationship between corporate environmental performance and corporate financial performance. And to do so, we have to dig into how we measure things. Some empirical evidence on the CEP-CFP relationship. Here I go back on results of colleagues of mine, also in Dresden, and they collected lots and lots of studies. And actually, there are lots of studies out there who examine the relationship between CEP and CFP. And here we used, or they used, a vote counting. They just have 3 boxes. The first one, is there a positive relationship? Next question, is there a negative relationship? Or is there no relationship, no significant, statistically significant relationship? And then you can see on the lines, for example, different things what have been examined. For example, strategic performance means what the management is doing. So it's more about environmental management things. Are there, you can see that 56% of the studies show a positive relationship, 36% show no relationship, and 9% of the studies show a negative relationship. Overall, what can we see? We almost find no negative relationships. And what we find is either a positive relationship or no significant relationship. And this depends on how we study things. For example, it matters whether you look in surveys, using questionnaires, or when you make event studies. For example, events if something happens. So for example, if a drilling station, for example, in the Gulf of Mexico is exploding or things like that, what happens to the firm and things like that. That is a typically event study. So overall, we can see no negative relationships. Either we find positive or no significant relationships. The second study I want to show here takes, in addition, into account the effect sizes. So far, we just had 3 boxes: positive, no result, negative result. And now we take into account the effect size. Effect size is here measured as correlation. So correlation can be between -1, negative correlation, 0 and +1. So the maximum is +1. If you go on the first line, what do we see? My colleagues collected here 245 studies. So there are so many studies out there. They capture more than 200,000 observations, which also is a big advantage of this type of analysis, what my colleague made here, which is called meta-analysis. So an analysis of other analysis. So putting a lot of different data, different studies together and aggregate the results. So what we see from the first line, overall, it's positive, a positive correlation. It's rather weak, but it's significant. So from the statistical point of view, we could say there is statistically a positive correlation between environmental performance and financial performance. If we go on the other lines, like always in research, we get a little bit of different view and different aspects, which also are worthwhile looking into because it clarifies a little bit things. So you could say, for example, that there is a next box is about corporate environmental performance in subsequent financial performance. So there's a time lag in between. Because sometimes it takes time to invest in environmental issues to unfold in the firm that you can see, let's say, the benefits from that. There are not so many studies who consider a time lag, but what we learn from that, time lag may be an issue. Because if you go on the next box, there is a CEP and prior corporate financial performance. So the relationship is actually the other way around. If you are profitable or if you have a lot of cash flows, does this have an impact on environmental performance? So the cause and effect line, you could say, goes in the other direction. And the last one is, so the majority of the studies, they use or they measure corporate environmental performance and corporate financial performance in the same year. And what you can see from the results here, you don't find negative correlations. So aggregated level, overall study says almost never a negative correlation between CEP and CFP. So it seems always to pay off. So correlations are always positive and significantly, what you can see from the asterisks here, significantly different from 0. And the so-called significance level is relatively high. So there is, concluding from that, first of all, many studies on the CEP-CFP relationship. So it's well researched. And overall, we have a positive relationship when the data is statistically aggregated. So far we could say there is actually, because of the many studies, the many observations, no doubt about it that CEP and CFP has a kind of positive relationship. The third, my third chapter, I would say, brings me to the measurement problem. What is corporate environmental performance? Because we have seen before that this somehow seems to matter. And here I'm referring to a study which other colleagues made, and they distinguish between environmental management performance. It's not only, I would say, a framework, it's a construct validity study. So they use empirical data of listed firms to analyze, does it make really a difference whether I look on environmental management performance? So what the management is doing, for example, indicators, what you can see here. What about the environmental policy? What about, does the firm have environmental objectives? How are they controlled and things like that? Do they have environmental processes and so on? So that are environmental management issues. Or do I look on operational performance? And what is operational performance? Is how do I as a company, as a firm doing with energy? What about water consumption? What about greenhouse gas emissions? What about waste? What about hazardous waste and so on? So there is what you can see here from this construct validity study. It makes a difference whether you look on operational performance or whether you look on what the management is doing. Yeah, and also within the operational performance, it makes a difference whether you measure energy, water, or what else. And also concluding from this study, there may be other environmental issues which matter, but where we typically don't have data on. So what they used is the so-called ASSET4 database, and you can just analyze where you have the data from. And when you don't have the data, you cannot analyze it. There may be other topics like, for example, biodiversity or phosphor or something like that, which are not covered. So what do we learn from that? Corporate environmental performance is a multidimensional construct, which is somehow not so easy to measure. And it also tells us it may be, or it may make a difference what we measure, whether we measure energy consumption, water consumption, or whether we measure environmental management performance. The same holds also for corporate financial performance, because here also another construct validity study, which I like very much because they use statistical data to show whether it makes a difference, whether how you measure things. So that is a construct validity study. And what they found is that we have 4 dimensions for corporate financial performance. Liquidity, things like cash flow. Profitability, things like net income, return on assets, return on sales. Growth, and stock market performance. So that are the 4 dimensions. And what you also can see here, different indicators, what had been found out in this study, how you can measure the things. So in our paper, we focused only on profitability and on stock market performance, because so far there are no other studies, for example, who measure liquidity or growth issues, even if, for example, there may be 2 additional dimensions worthwhile looking into. So far, we don't have much research, or so far, I would say, don't have any research looking on liquidity and growth. So last issue in my 3rd chapter, what is the direction and the form of the relationship? On the very left, you see a negative relationship. So more you invest in corporate environmental performance, or the better you are, the worse is your financial performance, a negative relationship. And below you can see the underlying theoretical ways of thinking, argumentation. There's a so-called trade-off hypothesis going back to Milton Friedman. And he had the saying, the business of business is business. So the purpose of business is to make profit. And if you invest in other things, like environmental issue, this distracts the company from the core business and results in lower financial performance. So that is a so-called trade-off hypothesis. There's a trade-off between investing in social and environmental things, and this deteriorates the financial performance. The next theory is so-called managerial opportunism hypothesis. Management gets incentives. Incentives are very often related, for example, to short-term shareholder value, short-term financial performance. And this results that management is not willing to invest in environmental issues because then they have to invest. That lowers, let's say, their returns, and that lowers the bonuses they get from the company. Third hypothesis, stakeholder activities. The argumentation is, if I want to satisfy stakeholders, for example, lobby groups or customers or the general public, I have to invest in so-called end-of-the-pipe technology. So, for example, to prevent pollution and things like that. This is costly. This lowers financial performance, and therefore stakeholder activities are against the firm. Last line of argumentation, if a firm invests in environmental performance, there may be outcomes where the firm doesn't see the benefit from. For example, the nature is better, pollution is lower, but the company doesn't see it in their income statement and their balance sheets. So these are all theories who assume a negative relationship between environmental performance and financial performance. It's the same we also find for a positive relationship. For example, the so-called win-win hypothesis developed by Michael Porter and his colleague van der Linde, who say, okay, it's good if there is public pressure, if firms are forced to innovate, that makes them more sustainable, that makes them more adapted to the environment, and finally will result in better financial performance. The next two lines of argumentation are the resource-based view and the natural resource-based view. The idea is if firms are investing in environmental issues, then they have to change their mindset, they have to change their organization, they have organizational learning, they are doing better, they create resources, competencies, which makes them more efficient, more profitable, and this will pay off and result in higher financial performance. In the last line, similar to what we had as a negative effect of stakeholders, we also have a positive effect. For example, if I satisfy customers better, so I can have a price premium, which will be higher than the additional costs. So I will have higher margins, and this will pay off for the firm. So that is the stakeholder way of thinking. So if we look on all 8 lines of argumentation, you could say, okay, there's always a little bit truth with every argumentation. So, and what do we have actually in reality? In firms, if you don't look only on listed firms, if you look on SMEs, what is the actual situation in firms? And if we put everything together, we get to the third, you could say, form of relationship. That is a so-called inverted U-shape, or to the fourth, that is a U-shaped relationship. So if we put everything together, there may be effects, for example, like too much of a good thing, there may be a maximum. Too much of a good thing means, so there is a maximum, and if you do too much, then financial performance will decline again. And that is also, let's say, can be explained with the line of diminishing returns, what we, for example, have in economics, which is very often a good explanation of what we observe in reality. And finally, the U-shaped relationship is a too little of a good thing. You have to invest the minimum that you see the effects. Yeah, if you do too less, then the effects will be negative for your firm. You have to jump over a hurdle that you can see the effect. So that is the last thing. And the question now for research, but I would say also for practice, is what do we have in reality? Does it really pay off? Doesn't it pay off? Do we have negative effects? Is there a maximum? Is there a minimum? What can we really see? But surprisingly, most of the studies I presented before just did look on the linear relationship, yeah, and didn't observe a nonlinear relationship, for example, like the curvilinear relationship, what we have in the third and the fourth picture. Let me give an example. What you can see here as a crosses may be the observations on the markets. Yeah, what you can see. So each cross is a combination of the environmental performance of a firm and the financial performance. The first thing what you can do now is, okay, we use a linear relationship. It's a red line. The red line is relatively far away from what we observe. What do we find in statistics? The slope is very low. Yeah, the slope, if you measure that, may be not different from zero, which means it's not significant. We get a study, what we had before, in the vote counting, we get a study which is not significant. And we have a poor model fit because the crosses are relatively far away from the red line. What can be another explanation? Can be this U-curve. This U-curve better fits, yeah, though it's closer to the real data. Yeah, what could we find is that the regression coefficients actually are significant when we use a nonlinear model and we get a far better model fit. That is exactly what we have done in our study. Do we get better if we use nonlinear relationship, quadratic relationships in relation to linear relationships? And what you also can see from the, let's say, a little bit simplified example is if we have in reality non-linear relationship, what we find in statistics in research papers is a lot of non-significant results, which may explain what we have seen in the vote counting, and which also may explain the relatively low effect sizes when we look in the meta-analysis. So it's also a matter how we analyze things and what we really can observe in reality. That brings me to our paper. What have we done? We use an international sample. So not only what has been the focus, Europe and Japan so far in a lot of papers, we use an international sample which covers global 500 from the Climate Disclosure Project, the S&P 500, and the FTSE firms. Over 5 years, 2008 and to 2012, and finally our paper was published in 2017. It also takes a long time, let's say, to bring it through the journals. So actually we have done the study in 2014, and it took us 3 years to finally get it published, and another year it was accepted in 2016, but it also takes a year that the paper is published. Our study covers 2,300 firm years in almost 500 firms, and we also did look not only in manufacturing industries, which has been so focused so far. We also looked in service industries, and the data is coming from Thomson Reuters and Asset4. We used regression modeling. What I also mentioned before is we used a time lag of 1 up to 3 years for corporate environmental performance. So we looked whether there's an effect 1 year or 2 year or 3 year later in the financial performance, and we use different controls, what I don't expect I explain now in my presentation here. Major findings, what did we find? We actually find U-shaped relationship of carbon performance, which is greenhouse gas emissions, with return on assets and total shareholder return. We find the same for waste intensity, but only for return on assets, not on total shareholder return. So it seems to be crucial how we measure and what we measure corporate financial performance. And there may be a different effect of carbon performance on stock markets in relation to waste intensity. My explanation is that carbon issues are much more aware on the stock market than waste issues, and then we get perhaps a better relationship for that. We also looked into service industries, and we find U-shaped relationship for carbon performance and waste intensity with return on assets, but not with total shareholder return, which also shows there may be differences between manufacturing and service industries. Perhaps service industries are not so much observed, not so much aware, creating awareness when looking on environmental issues, because it typically are said that they have a low environmental sensitivity. But I think that is not really true. What we also find is U-shaped relationship better fit than linear relationship. There is actually, or our interpretation of the data is, there's a too little of a good thing effect. It finally pays, but when you invest enough, yeah, you have to reach a minimum that you get the good financial payoffs from your investments. So that is what we actually find, and also the type, the form of the relationship is proved by our data. And what we also find theory-wise, they're all different argumentations may hold at the same time. So in the beginning, there's really a negative effect. Yeah, and if you reach a minimum of environmental performance, then it really pays off, and it pays off by far, what you can see from our graph here. Conclusions. First, for research, our research confirms the positive relationships of CEP and CFP, what we have found so far. It expands existing literature that we can use nonlinear models, and nonlinear models may better explain reality than linear models. So the form of the relationship is crucial. And it also confirms that the theoretical explanations overlap, that there's more than one explanation for what is going on in the reality, that the negative and the positive argumentations hold at the same time. And what he also may conclude from that, non-significant findings may be due to the fact that the researchers use linear models instead of quadratic models. For practice, there is the trade-off between positive and negative effects of environmental measurement, of environmental management, of environmental issues. Firms have to consider that both overlap, that they will have both effects, things which get hard if you invest more in environmental issues, and that you have to decide, for example, do I want to have a reactive or a proactive strategy or something like that. A minimum investment is required. Our problem in research is, what would be nice is we are not, but what we are not able to do is to calculate what is my minimum investment I have to do in my specific firm to get the good financial payoffs. What we also can conclude, it pays to be green, definitely. There are so many studies. Our study is also confirming what the other studies found before. But what is getting more interesting, I think, for the future is not, does it pay to be green? The question should be, how does it pay to be green? What is really going on in the firm? How do I make my firm more environmental aware, more investing in environmental performance, but also getting the good payoffs from the investments? So the question is, how do we find green business models in reality, which we cannot see from our research, which is more on the cross-sectional level? So thank you very much for your attention, and I'm looking very much forward to my discussion and also to your question. Thank you so much.
Thank you, Professor. Thank you very much. Really appreciate your presentation. I would leave the floor now to Dr. Mazzoleni from Suggestioni, who will discuss what you've just presented and providing points of view of practitioners on this particular aspect. Manuela, please, floor is yours.
Thank you very much. Thank you very much. Well, to FAME, first of all, for giving me the opportunity to discuss this paper and take away some time from, my daily activity, which is monitoring regulation and trying to see what's happening at European level with all these new regulation, and take some time to kind of move away from that and look a bit into the theory, the economic theory behind the sustainability. So that's thank you very much, because it's a very good opportunity. Also, I thank Dr. Günther for a very interesting paper that I thoroughly enjoyed reading, and I'm happy to be here to sort of discuss it, or at least I can say I will say I'm not I'm not academic, so I'll be just giving my overview of how how I read the takes of the paper, and maybe ask a couple of questions at the end, and then open it to the other participants to this discussion. Well, first of all, just about the question. The question is definitely still at the core of what is the sustainability and what the industry is doing, despite the fact there's a decades-old question, I would say, at least. As you've seen from the review of the literature, it's always, sometimes, because we've seen so much progress in the sustainable investing, as it's been moving out from what has been a small niche up to quite recently, we see moving out, we kind of think that these issues have been solved and this question has found an answer, but that's not the case at all. In fact, it's a very real and pressing question. So, the relationship between environmental investing and performance, and the correlation between the E and the financial performance. So that's as I said, it's still an open question. We see that for instance, just recently, as you probably know, there is the Department of Labor in the US as a regulatory plan of ban fiduciaries for 1Ks, the retirement plans, to include ESG criteria, because on the basis that the inclusion of ESG criteria may lead to an increase in cost without really, in that way, not really guaranteeing the best possible returns for investor and people who will retire. So, we see that really that question comes back on the table in a very real way. And on another level, we have the FT that just last week was saying again, you know, opening the debate on the relationship between green investing and profitability, and saying we should look at it as a matter of morals, not of markets. So that was you know, it's a way of looking at it. But then again, The Economist just a couple of days ago was saying that between 2014 and 2018, the returns of green venture capital has been on average around 20%, which is double what it's the normal returns on investment for VC. So again, we see that it's really still very much an open question that receives various answer, and so it's very valuable, this paper that tries to address again this question. And well, going to the specific of the paper, I found the review very interesting. That started from you know, statement of Milton Friedman that social responsibility of businesses is to increase profit, and that's it. So opening the whole thread of discussion about the trade-off, you know, the one saying that if you invest, it's just basically to the cost of profits. If you invest in environmental strategies or activities or mitigation of the output, and that kind of going through what happened and what would become the evidence over the following decades is that basically that statement misses out a number of ways in which, in fact, being environmental does affect profitability, financial performance in a broad way through be regulatory, preempting regulatory moves, improving the internal organization, having put in place a more efficient use of resources, addressing reputational risk and preventing damages from, you know, operational issues that affect the business. And I think that's really kind of it's a good setup for what comes afterwards, which I found very, very convincing, and actually it was very good. You know, the conclusion of being able to put together by moving from linear to non-linear, putting together the different threads that we've seen earlier. You know, the kind of the trade-off, kind of negative correlation to the positive correlation, putting them together into this non-linear modeling. So, you know, it's very useful to be able to reconcile these two elements. Also, going at the correlation, you know, how you divide you deconstruct this the environmental aspect into sort of carbon and waste, and you pick those two elements. I found that was interesting, and I was also thinking why the waste, with the carbon is more obvious, the correlation with waste not so much. So it becomes evident with profitability, if not by market on the stock market performance. And that might be very much the case that you know, the industry, the investors, the kind of asset management industry as well, is started looking with attention at all the climate-related issues, but not so much at the other aspect, which might be coming though into the picture now. Also, in part, at least in Europe, thanks to the EU Action Plan, which, you know, has identified those 6 areas of you know, which to deconstruct again the environmental aspect, which is, you know, the climate mitigation, climate transition, and you know, the other aspect that also include all the aspect linked to the circular economy, waste management, amongst, you know, the other aspects. So I was wondering if that is something that might be worth monitoring, you know, as it evolves, to see if that comes into the picture more strongly with more recent data. Another aspect that you mentioned also in your presentation is with the service industry, that, you know, the correlation is again low with regards to the link between the environmental performance and the stock market. I was wondering if there was any detail in terms of industry level, if there was just, you know, within the kind of the broad broad kind of grouping of service, if you know, there was any insight into kind of breaking it down by sectors. And that also would also apply in general, you know, to also industry, because industry is a lot of things. And so you will kind of think that while I would expect that in some sectors, like those really very energy intensive, which were obvious environmental aspects, like, you know, I don't know, the energy industry, for instance, you would have a very strong correlation with investing or not. You know, maybe that would be quite interesting to go at that level, you know, breaking down these macro groupings of industry and services. And another one, which was more like is more deep, you know, it's more about detail, but I would like to have an answer, is when you insert in the control variables, that variable which is called legor, which is the you know, the difference between common law and civil law countries, and that you're expecting one to perform, to have more attention towards profitability and market performance than the other one. I would like, maybe you can explain a bit more that is the case, and why do you think that's the case? And then as a conclusion, as a general and a more general comment, I think it'd be interesting to see this this study, as I said earlier, expand more into the differences between the various industries and services, but also kind of move into the S, you know, look at the S aspect, which is possibly even more source of discussion, controversy than the E, which in a way has become a bit more accepted as an element to be taken into account of, while the S is still, you know, there's a lot of talking about it, but then what happens really when you do take the social aspects into account and performance, I think that's even possibly a bigger question mark. So I think that's you know, that I will kind of close here with my comments, and well, leave it either to Professor Günther or to other people just to add in. Thank you very much.
Okay, thank you, Manuela. I just want to go to 3 of your remarks. Service industry. I think this is somehow in general a little bit overlooked, whether there is an environmental effect or not. I think the complexity is relatively high. So I'm following your remark that we should break it down in different groups, which might be interesting, because I think here it's worthwhile to learn what do we consider as service. Are there differences between different kind of service industries? For example, if you go look on transportation or banking, and so there are of course crucial differences. The legor variable, the legor is legal origin of the firms. We measure, let's say it's just a dummy variable, whether it's common law or code law. So 2 different kind of law system. And the general line of argumentation is, if you have a common law system like US or UK, you are more shareholder oriented, not so much stakeholder oriented, in relation, for example, to Italy, France, or Germany, where we are more stakeholder countries. So by nature, you could argue that stakeholder countries have more stakeholder way of thinking and are more environmental aware. So that makes a difference. What they also somehow can observe on markets, and there are also other studies about that. And a very interesting issue what you are addressing is social performance. I think social performance has much more, is really diverse. It's much more dimensions, and I would say it's not so sure what different dimensions we have with social performance so far. If you look, for example, on global reporting, initiative reporting, for example, you have things like labor relations, human rights, diversity issues, etc. So you have a lot of different, you could say, dimension what you have to consider. And from my point of view in research, it's not quite clear what we really understand under social. In the past, it had been very much for things like donations or something like that, what from my point of view is part of the social dimension, but not really measuring the social dimension of a firm.
Okay. Thank you. I think that's very true about that, especially about the social aspect. I mean, it's obviously a big question. Also, for everyone, when we talk about the S, it's still very much a very sort of liquid concept that is just difficult to pin down. Although I think things will change thanks to the what's happening at the regulatory level within the EU, because they will come up, there's already now coming up with indicators and with kind of definitions that, whether we like them or not, that at least they will give a shape and a form to this concept. So maybe there'll be more more ground to build a research on. And also, I think the distinction between the various industries might be also interested. Also, when you talk about not just about the service, but also within the industry area, where you have your model works, so it would be good to see how it works for the various industries. I think that's an interesting tool for investors as well, to see how much that correlation works within the various
investors typically want to have industry-specific benchmarks, which is very interesting. And also, let's say, as a practitioner, I would like to have that. But it's, let's say, from the data what we have so far, it's very difficult to derive, because what we have in our databases, though it's not, I think, industry-wise, I would say the measurement is not so clear.
Mm-hmm. Yeah.
Okay. Thank you very much. I would get a couple of questions from the audience if you're okay with it. We already have a couple for the professor. I will forward them to you. You should see a banner on your screen.
Mm-hmm.
And there is a follow-up of the same question you're reading right now.
Okay. Yeah, the one question, what I can see, I'm not sure if this is what you mentioned. Did you measure oil and gas company sample?
Yes, that's the first question, and there's a follow-up asking, and if yes, what is the relationship between CEP and CFP?
Yeah, though I'm sure we have oil and gas companies in our sample, but actually we did not analyze separately oil and gas companies. So it's all in the sample, in the subsample of manufacturing industries. So we didn't make subgroups so far in analyzing the effects just for oil and gas. So I'm sorry, we don't have that for oil and gas.
Okay, I guess there's a third question I am forwarding to you. It's a little bit longer.
Okay.
You should be able to see it right now.
Okay, good question. Emissions are relative to sales. So we didn't measure absolute emissions. It's always in relation to net sales. I personally struggle a little bit with this scaling because, for example, better scaling from my point of view would always be so the value added to what is really going on in the firm. Yeah, but we tried that several times, and there hadn't been good results for scaling it with value added. So, and everybody else, I would say, in research is also using sales. So it's the answer is it's relative emissions. ESG disclosure, that is also a very good issue. For example, one issue is if it really pays, if green investment pays, you wouldn't need regulation because then everybody would convinced that is the best investment. If it's really paying off, then we don't need regulation because every firm would invest in green issues. So that is my first statement about disclosure. As also Manuela said before, but nevertheless, so in some issues, it helps very much that we get a little bit of structure, that we get a minimum reporting, at least for the big companies, which help us to clarify what is ESG, what data do we have to deliver, and also, let's say, as a researcher, it helps us to fill the databases that perhaps in 10 years we can make better analysis. For example, in SF4, you also have a lot of e-data and a lot of data on social and also a lot of data on governmental issues, which is very interesting to analyze. So disclosure is really supporting for research, but also a little bit structuring what is going on in industry. And there's also research on analyzing what is the relationship between this triangle of disclosure, performance, disclosure, environmental performance, and financial performance. This is also where you find study because they all interact with one another.
Thanks. Yeah, I agree on this. On the second point on disclosure, is a little bit more different thing, but really helps when it comes to collect data. If there are not any other questions, I would end the webinar. We're being a bit long. Anyways, I would like to thank Professor Günther very much for being here with us today, and naturally also
Pleasure.
who managed to be with us today and discuss with the professor. I would like to thank again Net Community and the Italian Sustainable Investment Forum for collaborating, and naturally our partners CEP, A2A, Acea, Cattolica Assicurazioni Generali, and Unipolsai and Utilitalia, who continue to support us in our dissemination activity. Let me remind you our next event, which is, as I said, a workshop on the tools and methodologies that are being developed for assessing financial impact of climate-related risks and opportunities, which will be on the 20th of November during the SRI week, which is beginning on the 11th, which is organized by the Italian Sustainable Investment Forum. Again, I hope you enjoyed the event. The recording will be published soon as we process the video, and we can publish also the professor's slides. It's been a pleasure on my side having you as guests. Again, have a nice evening.
Thank you. Thank you again. Bye. Goodbye.
Bye.
Thank you very much.